Good afternoon, everybody, and welcome to this briefing on the Leverage and Non-Bank Financial Intermediation Final Report from the FSB. My name is John Schindler. I'm the Secretary General of the FSB, and I'm very happy to be here. Thank you, Andrew, for hosting us today. My role is just to keep things going, so I'm going to introduce the people that are here with me today. I'm going to start with Sarah Pritchard, who is Executive Director of the UK FCA, and one of the co-chairs of our group on the work that we're presenting today. Also joined by Cornelia Holthausen, who is the Director General of Macroprudential Policy and Financial Stability, I hope I got that correct, at the ECB, and also one of our co-chairs of the work that we're presenting today. And of course, I'm joined by Andrew Bailey. He's got some other roles, but the most important one is the chair of the FSB, and he is going to kick us off today. And I just want to start by saying thank you, Andrew, for taking on the role of chair of the FSB. It's a huge role, and we are very happy that you've taken this on. Me, probably more than anybody, because I'm going to take all my direction from you, and so I'm really grateful that you took this role on. So we're going to start with Andrew's presentation, and then I will turn to Sarah and Cornelia, and then we will open it up for questions. Andrew, please.
Well, thanks, John. It's really good to be here. I should say this is my first event today as chair of the FSB on financial stability, but it's not my first event on financial stability in here because we've just actually finished presenting the half-yearly financial stability report in my other role as Governor of the Bank of England, so it's a little bit weird to be in here for a second time today. But a great pleasure, and obviously a great pleasure to host a launch event for the FSB's NBFI leverage report here. And I think the first thing to say is that this report is really is the latest example of the FSB's vital role in the global financial system. And of course, the FSB's role, which is essential in bringing together policymakers and their expertise from across the world to enhance financial stability. It's been my pleasure really to be involved in the FSB for quite a long time, and it's a great honour to become chair. And I want to start by giving all our thanks, I think, to Klaus Knott, who was, of course, chair until last week, for his exceptional leadership during a period of time when obviously a few things happened on the world financial stability front. So really, Klaus did, because he took on the role during the COVID pandemic, really do a huge job to not only support the FSB's work but also develop it, and say great thanks to him. And one of the things that Klaus was very clear on, and I've been very strongly supporting him, particularly during my time chairing SRC throughout most of his period, has been that, of course, it is vital that we have, through the FSB, a globally coordinated response to the shocks that we're seeing, to the risks that financial stability that we're seeing, and that the international standards that we uphold, are explained and their importance is explained. And this is vital in the current context, frankly. And Klaus did that in a whole range of areas that were important to financial stability, banking reforms, crypto regulation, impact of climate, operational resilience. The FSB's workload and agenda has not been short of things to fill it up. But it's interesting that we're here today to talk about non-banks, because one of the things that I also observe quite often is that since the financial crisis 15 years ago, we have seen a shift in the balance of intermediation in the world financial system from banks to non-banks. I don't think that's not surprising, and B, it's not shocking. It shouldn't be regarded as surprising, because one of the reasons we had to make such a big response to the financial crisis was because there were things going on the balance sheets of banks that were not suited to the balance sheet of banks. So the fact that these things have moved out into an expanding non-bank financial sector should not be a source of surprise to us in that sense. But obviously it's thrown up its own challenges, and today we're publishing recommendations for managing risk related to non-bank leverage. All the work and all the credit goes to Cornelia and Sarah, who have done the work, provided outstanding leadership over quite an extended period of time to produce what is a very substantial piece of work and a very substantial set of recommendations. In what, as I said, is very much the focus now of our regulatory work, because of the changes that we've seen, the important changes that we've seen. So start by saying, how did we get to the publication of this report today? Well, as I said, over the last 10 to 15 years, we've seen this real change in financial markets. And we've seen very big changes in financial markets. If you take, for instance, core government bond markets, we've seen very big changes in the role of non-banks in those markets. And we've also, in doing that, seen what I would see in those markets is a decline in the relative decline in the role of sort of traditional bank dealer activity and a growth in non-bank activity. But if you put all of that together, non-bank activity today accounts for around about half of global financial system assets. Around in 2008, I think investment fund assets were roughly $21 trillion, and in 2023, the most recent aggregate number, I think we have about 52 trillion. So it's more than doubled. So it's not just changed the size of the non-bank sector. It's obviously shaped and reshaped how the financial system functions through this move out into the non-bank sector. What we've also seen is an increase in reliance on non-banks for credit intermediation and liquidity provision. We've seen a growth in the complexity and interconnection of business models in the financial sector among financial firms. We've also seen developments which have been less transparent to markets and to regulators in terms of what goes on, all of which throw up challenges. Because if these developments are not properly overseen, managed, and supported, then these features can lead to sharp spikes in liquidity demand that can outpace supply. We can see pro-cyclicality develop. We can see fire sale type situations become a risk and develop. We can see sudden jumps to illiquidity. And those are obviously things that are of great concern to us at the FSB in terms of the threat to financial stability. Now, I want, however, to be very clear. It's not the case that we should regard these changes as inherently negative. There are benefits. We've got, I think, they can and do lead to more efficient markets. They can and do lead to better price discovery and broader access to finance for the real economy. So we have to recognise that alongside, yes, there are vulnerabilities, there are benefits as well. And it's our job to, in a sense, chart the course to get the benefits without introducing too many of the vulnerabilities, or preferably any of them. And we have to, of course, start by having a very clear sense of what those vulnerabilities are. Now, of course, we've had some experience on that front. We saw these vulnerabilities crystallise in 2020 at the outbreak of COVID, the onset of that. We saw global financial markets experience very severe stress. What's commonly known now as a dash for cash, subject that's been frequently discussed at many FSB meetings. And that has brought into sharper relief vulnerabilities in the non-bank sector. We saw in that time very significant outflows from money market and open-ended funds. Non-government money market funds saw outflows of 11% to 25%, depending on the type and the currency. We saw weekly outflows in the US corporate bond funds of around 5% of assets under management. These, until central banks stepped in, these are big numbers and a threat in their own right. We saw rapid redistribution of liquidity due to margin calls. We saw material dislocations at that time in key markets, key government bond markets. And we saw a spike in demand for the most liquid and safe assets. So that led to a decoupling of prices. The normal price correlations broke down. And in that, I think we saw the role that leverage can play in that mechanism. We saw hedge funds being forced to unwind, we think, around $90 billion of so-called basis trade positions at that time as they became largely loss-making, and that in itself creating very severe illiquidity in markets. And of course, what happened was that public authorities had to intervene in unprecedented ways to prevent that dysfunction spreading and becoming much more of a financial stability risk. Now, I'm not going to go through every crisis that we've had in the last 5 years in detail because the day is not long enough. But we've had other examples. We've had Archegos, the failure of Archegos. We've had volatility in commodity markets. We've had following Russia's invasion of Ukraine. We had our own experience in the UK with the LDI issue. And obviously in March 2023, we had disruption again in US markets. And we've had disruptions in markets in recent months. So we've had some near misses as well in financial stability terms. So in response to that dash for cash at the beginning of the COVID period, the FSB, which was then under Randy Qualls' leadership, developed a multi-year work programme to address these vulnerabilities in the NBFI sector. And the goals of that work programme have been to reduce excessive spikes in liquidity demand, enhance the resilience of liquidity supply during stress, and improve risk monitoring and preparedness among authorities, but also critically amongst market participants. And developing a policy response to vulnerabilities identified under this work programme has rightly been a priority for the FSB and for those of us also involved in the SRC, of which I say I was the chair. And actually, as each of these new stresses have come along, I think the one very clear message we had from that was that the importance and priority of this work has only gone up. Now, you may say, well, that's 5 years. And yes, we've been seeing very real deliverables, very real conclusions of that programme over this period. So in response to severe liquidity mismatches in money market funds and limited use of liquidity management tools in open-ended funds, the FSB published a new policy framework for MMFs. We revised the OEF recommendations in collaboration with IOSCO. And with the standard-setting bodies, we've issued policies and best practices and recommendations to improve margining practices and strengthen market participants' preparedness to meet margin calls. All of that's important and significant. Now, it does, of course, then rely, as the FSB always does, on jurisdictions implementing these recommendations, because, and also I should say, implementing them in a timely fashion. A, because it's important, but B, because I'm afraid that if they don't get implemented, or if there are sort of good intentions which don't come about quickly, as time passes by, the memory of events like the dash for cash starts to erode, and we find that the environment in which we're trying to implement becomes more difficult. People start saying, but that was a long time ago, you don't need to worry about that anymore. I mean, I'm always struck by the number of people these days who are telling me that the financial crisis was sort of, ancient history. And you've done that, haven't you? You can move on. Now, we know, of course, it's not like that with financial stability, but it's an important point about implementation and why, I do think that getting on with it is of the essence. So, the NBFI leverage report that we're publishing today is another major plank and policy reform in this process. There are 9 recommendations to address vulnerabilities to financial stability, particularly in core markets, particularly arising from the interlinkages between leveraged non-banks and systemically important financial institutions, because it's not just a question of how big the non-bank sector is, it's how it interacts with the other parts of the financial system, including the sort of the traditional core. I think these nine points provide authorities with a comprehensive toolkit to put in place a domestic framework to identify, monitor, and then tackle, where necessary, these vulnerabilities in NBFI leverage. I think it's a very, very good basis for doing that. It's obviously timely, given everything we've said, timely because of vulnerabilities and volatility we've seen this year, but it's also timely because this growth of the non-bank sector continues. It's not something that has, obviously reached its endpoint. And we see this in many government bond markets. I've had a number of other governors come up to me in recent months saying, you know what, I've looked at our government bond market and it's changed. It's changed hugely. And they have. So these things are still going on around us. So it's important in that response. So it's important that we take the next step then and move into implementation. Now, it's sensible when we're dealing with global responses to build flexibility into the terms of implementation. That's a necessary thing. We've learned that by experience. But it's also, I think, necessary to combine that with a commitment to do it. Not least because of the high level of interconnection within the system. So none of us are islands in this respect. Now, I think two challenges stand out in terms of what we have to do and what we need to do to stay ahead and to be ahead of this game. First of all, in the uncertain environment that we live in, I think strengthening our ability to anticipate and assess vulnerabilities is critical. Surveillance is really the starting point. The FSB has a unique vantage point in this respect because it's a global organisation, but we have to have, along with national authorities, very robust toolkits to identify vulnerabilities, both the ones we have and the ones that are emerging and the ones that we might have in the future, and then take steps to mitigate them before they crystallise and propagate through the system. That's critical. So surveillance really is the starting point. Now, an important part of surveillance is data. We are already leveraging international cooperation to make progress. That's leveraging in the best sense of the word, by the way. But it wouldn't be an FSB meeting without talking about lack of data, lack of access to data, that the data's out there and we just can't get our hands on it. And we have therefore got a specific task force, which I'm currently chairing, to seek to make progress to addressing gaps in data, because I don't think that unless we do that, I don't think we're going to be able to declare that we have really got on top of this issue. So that's critical. And what follows from that then is my second point, which is effective implementation. That's going to be critical as well. Now, we can get started on that, by the way, while we're doing the data work. I don't think that implementation has to wait for the data work. But there's no doubt that implementation will be, A, more effective, and B, facilitated by making real progress on the data work, which is why we give it such priority. So I'll finish. It's also important that we have, obviously, a level playing field on which cross-border firms can operate. That's critical. It's critical that we protect against market fragmentation, which can happen when reforms are applied inconsistently. So that's why we need to work together, continue to work together inside the FSB, to make sure we can see how implementation is going. We can do all the work that we usually do to assess it, to review it, to assess the progress on it. Because international coordination is critical, not just in the design and calibrating the reforms, but putting them into practice. So we've made good progress, very good progress to get this far, but I'm afraid I am going to, you have to really in our role, end on a sort of cautionary note. It is still early days, and during my term as chairman of the FSB, this will be a very important priority to make progress on moving forward with now implementing these reforms. So I'll hand over back to you, John. Thank you.
Great. Thank you, Andrew. I think your remarks do a nice job of placing the work that we're talking about today into the context of the broader MBFI work program, what motivated it, and also you're already highlighting the next steps. I really appreciate that. I think there are some questions that people will have about sort of the nitty-gritty. You referred to the 9 recommendations, and since Sarah and Cornelia put a lot of blood, sweat, and tears into developing these with the team, I'm going to turn it over to them. They have a short presentation, so I'll ask the folks here to put the presentation on the screen, and Sarah, I believe you're going to kick us off. Thanks.
Many thanks, John, and many thanks, Andrew. Now, I will begin by speaking about the report's approach and scope, and about the first group of recommendations, which are all aimed at identifying risks. These are recommendations 1, 2, 3, 6, and 7. And I will then pass the floor to Cornelia to speak about the second group of recommendations, which deal with addressing risks. So firstly, it's important to state from the outset that the recommendations form an integrated approach. This is an integrated approach through which authorities should first have a domestic framework in place to identify and monitor financial stability risks created by NBFI leverage, and then secondly, should take steps to select, design, and calibrate policy measures or combination of measures that address the financial stability risks identified. It's really important to note that we have listened to industry feedback and we've adjusted the report in light of the concerns and suggestions raised during the public consultation. Notably, we've refined the report's approach to better reflect the complexities of the NBFI sector and the risks created by NBFI leverage. First and foremost, the report now explicitly recognises the high degree of heterogeneity amongst non-banks. We've also highlighted that leverage in some NBFI segments is relatively limited and isn't likely to pose financial stability risks. We've highlighted the differences between banks and various types of non-banks, which have motivated different regulatory approaches. And finally, we've recognised the complex and varying nature of NBFI leverage in different jurisdictions. So if I move now to scope. In terms of scope, the recommendations focus on the markets, entities and activities where NBFI leverage can create financial stability risks. Entities in scope are non-banks that either use financial or synthetic leverage, including hedge funds, other leveraged investment funds, pension funds and insurance companies. Banks and broker-dealers are also in scope in their role as leverage providers where relevant. The first three recommendations relate to risk identification and monitoring. The first emphasises that authorities should have a domestic framework to identify and monitor in an effective, frequent and importantly timely and proportionate manner the financial stability risks created by NBFI leverage. This is the first core element of the integrated approach. Now, in response to comments received in the public consultation, the final report emphasises that authorities should take a system-wide perspective. Now, that means where feasible, domestic risk monitoring frameworks should appropriately capture the amplification role that interconnectedness, concentration, crowdedness and liquidity imbalances can have on financial stability risks created by NBFI leverage, and instances of regulatory arbitrage in how leverage is provided to non-banks. The second recommendation complements the first and relates to data challenges, which has already been touched on. It sets out the need for authorities to assess and address data challenges in their domestic risk identification and monitoring frameworks, such as data gaps and data quality issues. The recommendation highlights that authorities may need to collaborate to reduce the challenges that may hinder effective cross-border risk identification and monitoring, potentially including through better data and information sharing. And additionally, in response to public comments, this recommendation now puts more emphasis on the effectiveness of regulatory reporting regimes and stresses the need to promote common approaches to data collection among authorities. Authorities should collaborate where appropriate to reduce challenges to effective cross-border risk identification and monitoring, including by promoting better data and information sharing. And now the third recommendation looks at how public disclosures could help to identify risks created by NBFI leverage, particularly issues of concentration and crowdedness. It recommends that authorities review the granularity, frequency and timeliness of existing public disclosures and determine whether additional or enhanced public disclosures should be provided to the public, looking at both the costs and benefits of doing so. I'll now turn to recommendations 6 and 7, which aim to address the risks from interlinkages with systemically important institutions. Now, these two recommendations support market participants' counterparty credit risk management practices through encouraging an enhanced information flow between leveraged entities and leveraged providers. The report recognises that an important element of a comprehensive policy response to financial stability risks created by NBFI leverage is the work undertaken by the Basel Committee through its updated guidelines on counterparty credit risk management for bank leverage providers. Recommendation 6 asks that authorities ensure the timely and thorough implementation of those guidelines and that they monitor developments in the way that NBFI leverage is provided, including from a systemic perspective, to ensure that the framework remains appropriate. Recommendation 7 looks at the complementary aspect of information disclosed to leverage providers by leveraged entities and states that authorities should review the adequacy of existing counterparty disclosure practices between leveraged non-banks and leverage providers. It provides for authorities to consider, where appropriate, mechanisms, standards and/or guidelines to enhance the effectiveness of these disclosure practices, which could be developed in partnership with the industry. Now, this recommendation has been modified in light of feedback from the public consultation to more explicitly recognise a potential role for a public-private partnership, which could resemble similar public-private groups which worked on the FX Global Code and the LIBOR transition. Such a group could incorporate both buy-side and sell-side views, building on industry experience to ensure that the resulting enhanced disclosures would be practically useful for risk management purposes, whilst also protecting the confidentiality of commercially sensitive information. It could also explore the specificities of different types of non-banks and their leveraged activities, with the aim of harmonising data and metrics and standardising counterparty disclosure practices where appropriate. Now let me turn now to Cornelia, who will discuss the second group of recommendations.
Thank you very much, Sarah. So the second part of the recommendations is about the policy measures that authorities should take in response to the risks that they identify. And as Sarah already mentioned, it is worth highlighting that the recommendations provide authorities with flexibility to tailor their policy response to the circumstances in their jurisdictions. Authorities should select, design, and calibrate policy measures or combinations of measures that are most appropriate to the financial stability risks from NBFI leverage that they identify, while at the same time considering any adverse effects. Recommendations 4 and 5 relate to NBFI leverage in core financial markets. Recommendation 4 states that authorities should take steps to address the financial stability risks created by NBFI leverage that they identify in their core financial markets and develop a comprehensive and coherent approach to address these risks. Wherever appropriate measures are not yet in place, authorities should select, design, and calibrate measures that are effective and proportionate to the identified financial stability risks. Recommendation 5 sets out the types of measures from which authorities should consider were most appropriate to the risks they identify, also taking into account potential unintended consequences, as well as the measures taken in other jurisdictions to address similar risks. Let me be more precise. The report considers a broad set of policy measures, including activity and entity-based measures, as well as concentration-related measures. First, the activity-based measures can be used to target highly leveraged strategies employed by a wide range of non-banks, including those that lie outside of the regulatory perimeter. Second, entity-based measures can be used to directly constrain the amount of leverage and thereby enhance the resilience of leveraged non-banks or cohorts of non-banks, where the use of leverage can create financial stability risks. And thirdly, concentration-related measures can target the amplification effects of concentrated leveraged exposures in certain markets or products and can be applied at the entity or activity level. The recommendations require that authorities consider any adverse effects of specific measures and, if necessary, calibrate policy measures with the aim of minimizing any unintended consequences. In addition, when tailoring policy measures to the specific risks identified in their jurisdictions, authorities should aim to minimize opportunities for cross-border arbitrage. Now, moving on to the last two recommendations. Recommendation 8 relates to instances where various forms of NBFI leverage provision are subject to incongruent regulatory treatments and where this may result in regulatory arbitrage that can increase financial stability risks. Authorities should determine whether and how to address identified incongruencies. When acting to promote congruent treatment within their jurisdiction, authorities should also have regard to the treatment of similar instruments or structures in other jurisdictions and the actions or intentions of relevant authorities, so that domestic remediation efforts do not create new disparities that could transfer risk across borders. And Recommendation 9 emphasizes the importance of cross-border cooperation and calls for authorities to engage proactively with their peers to facilitate coordinated crisis and/or policy responses to the extent that this is feasible. This recommendation recognizes that international cooperation on the implementation of policy measures is critical to mitigate cross-border spillovers and avoid regulatory arbitrage. To support and assist authorities in implementing the recommendations, the FSB and standard-setting bodies will undertake further work. This work will begin with supervisory discussions, and later this year will consider whether to initiate follow-up work. This may focus on policy measures to address risks created by NBFI leverage in core financial markets, relating to the recommendations 4 and 5, and also on counterparty disclosure, referring to recommendation 7 here. The report then concludes with a set of general principles to help guide authorities in the selection, the design, and calibration of policy measures. Thank you. Let me stop here. Over to you.
Thanks, Cornelia, and thanks, Sarah. And Thank you for giving the presentation, for going into a little bit more depth. I greatly appreciate it. And thank you both for taking on this task. We do a lot of work. We have a lot of working groups that are set up, but few that quite have the scope and then the importance, because it is recommendations as opposed to some of the other work that we do. Greatly appreciate all the work that you've done there. So for those who are participating in the webinar, you have the ability, I believe, to input questions. I think we also received some questions in advance. I have some staff here who are going to continue to field the questions and will feed us some. We did get some questions in advance, and I would sort of bucket them into a few categories, some of which we've covered, but since they showed up, let me ask a few of these. Andrew, the first one maybe is for you because you touched on implementation, and people want to know how we're going to support implementation of these recommendations. Is there anything unique? Is there something different? So that's maybe a question for you and I, but I have the right to pass the questions on. So
no, that's fine. Well, let me start, but I think actually Sarah and Cornelia have also made some important points, which I'll come back to in that sense. As I said in my opening remarks, there's a number of ways I think where it's important to support taking forward these recommendations. I'll just start back to the data work we're doing, because I think that's an important building block. Authorities have said to us very consistently that they don't have access to the data they need to do this work. And as I also mentioned, we clearly have to have a view across jurisdictions as well for these risks. So the data work is important. Now, what we're doing on the data work is that we've decided to, having put the group together, we're going to start with a test case. And the test case essentially is drawn from this scenario, from this work. So the test case is leverage in the non-bank world. We wanted to sort of take the one that was really most relevant and most timely. And we're going to use that test case to essentially demonstrate, what can be done and where the gaps are in terms of what can't be done, but we think should be done. And then, of course, answer the question, how do we fill those gaps? Now, there have been many discussions over the years on this subject, and as I say, it's currently the chair of this group. I mean, my approach is, I'm afraid, is that we're not going to stop this until we've actually, got to the bottom of this and tackled the issue, because without it, I'm afraid we're going to end up frustrated in this work. So that's an important building block. I think, Cornelia, you referred to supervisory discussions that are going to be one of the next steps, that we're going to bring together supervisors who obviously are on the ground doing this work, because it's very important that they're part of this exercise to, in a sense, take these proposals now and actually put them into practice. So, as you said, I think that's going to be a job for the rest of this year to actually say, because often supervisors, I know from my experience, come in and say, well, it's all very well for you to write this down, but let me tell you how it really works. And we need to understand exactly what the issues are there. So that's another one. Now, the final thing I'll say, John, on this is that obviously, as we do in the FSB, as well as track how implementation is going, we will, of course, set a milestone, as it were, looking forwards, where we will review implementation, as we always do in the FSB, to see how it's going. And I think we'll probably have some interim milestones and some hopefully more final milestones, because it will be important not only to track how it's going across countries, but also to track, as I said, how effective that system then is in terms of looking at the overall risks.
Great. Thank you, Andrew. Another set of questions, I think, are on the scope of these recommendations. And this was touched on in the briefing, but is this something maybe one of the co-chairs wants to say a little bit more? Who are we focused on? Which types of entities? That sort of thing. So let me turn to the co-chairs. Maybe Cornelia, do you want to start?
Yes, I can start. So basically, we have in the scope all the non-bank financial entities that use leverage. We're thinking both of financial leverage and also synthetic leverage. So this could be hedge funds, pension funds, insurance companies, and also other leveraged investment funds. But I should say that we are not focused on the entities themselves. What we are really after is the leveraged activities that they are engaged in. And we always do this with the perspective that we care about financial stability risks and possible contagion. So this is really the hook that we have and that we are interested in. We are, of course, very much aware that it's a very heterogeneous sector. No, there are different entities, they have different business models, and their activities have also different implications for financial stability. Some of them are already regulated in different ways, and that they may play a different role across jurisdictions. So, and this is the reason why so much flexibility is given to authorities to deal with this with this issue. I should also say that we always encourage here the authorities to be proportional, to really consider this financial stability risk and contagion, but also to consider side effects, no? To really be sure that whatever is recommended and is then implemented, doesn't backfire in some way.
It's just 2 points here to back up what Cornelius just said, because it's just sort of things I've learned from experience in recent years. So I mentioned Archegos as the starting point. I think Archegos is a really good example of a situation where no firm could risk manage its exposure in that case unless it could see the exposure across the market, because frankly, and this was the problem, there weren't. Because unless they could actually see the totality of this, and unless the supervisors could see the totality of this, you could not understand what the nature of it was. The second one, as I also mentioned, was the metal market issues that we had, because there the issue was that if you were risk managing positions on the exchange, you couldn't risk manage those positions unless you could see what was going on in the OTC market, unless you could see the degree of leverage there was, because again, you just were not getting the full picture. So those two cases, to me, underline the importance of moving forward on this.
So another set of the questions that we got in advance talk about maybe there's a common criticism about using bank-like regulations for non-banks. So do we plan to impose bank-like regulations on the non-banks? And Sarah, maybe I can go to you for this one.
Of course, and now that is something that we heard a little through the public consultation, which is where, as I said earlier, we've sought to address feedback through the final report and be very clear that this package bears no resemblance to bank regulation. The final report acknowledges clearly the difference between banks and non-banks and doesn't advocate for a one-size-fits-all set of bank-like regulations to be rolled out. It very clearly recognises the heterogeneity of the sector and, as Cornelius discussed, of the types of NBFI entity that are in scope. The report really clearly discusses how different tools could work and the potential unintended consequences. So, for example, we understand that blunt leverage limits, such as those used on banks, could work in some circumstances, but in other cases might not be effective. So that's really at the heart of the flexibility that is designed at the heart of this report.
Great, thank you. Andrew, you've already touched on this, but another set of questions were around the data, and you sort of touched on, the data issues that have come up in a wide range of things. I think some people are, why are you so focused on data? You've got all these issues and you're talking about data. Can you maybe say a few more words about, how important the data is, what we use the data for?
I mean, I think unless you've got the data, and I'll come on to make another point on it in a moment, but unless you've got the data, you don't have the line of sight. I mean, it's that simple. So that unless we can see the data and see the data across the market, we really cannot, and I don't think anybody can say they fully understand the vulnerabilities that are there. Now, the other point I'm going to make is really from experience, and I can talk a little bit from Bank of England experience here. So we've had access for, probably the last decade to trade repository data, which is a vast trove of data. It's taken us about a decade to actually work out how to clean these data up into it's a vast data set. I mean, trade reporting, obviously, Sarah knows better than I do, gives you a vast access to data. That's a good thing and a challenge because of the sheer scale of the stuff. And the trade repository data has taken us, I think, in the Bank of England about a decade to really develop systems and approaches to sort of clean the data, interpret the data. And we are now actually, we are now in a position where colleagues are developing tools and have developed tools which are extremely useful in terms of actually being able to then sort of, in a sense, concisely present the picture in this area. So, I emphasise data not only because it is the bedrock of what we need to look at, but also because it is very challenging in these markets. I mean, these markets generate vast amounts of data because of the scale of the activities that are going on. And it's the old problem of sort of finding the needle in the haystack. But we first of all have to sort of, in a sense, get the haystack sorted out and be able to look at it properly. So it really is important.
Appreciate that, Andrew. Thank you. I think just my own phrasing of that is, we need data to assess the vulnerabilities. If we have assessed the vulnerability, we need data to calibrate policy responses. And there are issues, and you've highlighted these, about whether or not data is actually reported. Banks report a lot of data, non-banks maybe different types of data. Is the data properly used? You highlighted the fact that you could have gobs and gobs of data, but maybe it's not properly used. Is it the right quality, or was it collected for the right mandate? There might be data collected for an investor protection mandate, but it might not be appropriate for the financial stability mandate. So you might want to change that or fix the quality. And then one institution might collect the data, but another institution in a jurisdiction might have the Financial Stability Authority. And can they share data, or can they share information gleaned from the data? So there's a whole constellation of issues there. We've had a question come in. I would describe this as a relatively technical question.
That means very technical.
Means I don't know the answer off the top of my head, but that's why I have people here to help me with these. Cornelia, I think this might fall into some of the ones that you were talking about, but Cornelia or Sarah, would mandatory minimum haircuts for repo need to be enforced on non-banks rather than just on banks as per the existing Basel standards? So do we touch on that specifically? Maybe you want to...
I think we don't touch upon it specifically, but we have already a framework in place. So the existing FSB and the minimum haircut framework covers transactions where non-banks obtain leverage against collateral other than government bonds. And it's now important that we also look at the framework for non-centrally cleared SFTs backed by government securities. And the idea is that those entities are in scope that obtain leverage, so the non-banks that obtain leverage including from the banking sector side by providing collateral. So I would say it's the idea is that it's targeted to the non-banks, but again, I would say it's up to authorities really to decide what they have in mind and what caters best for their specific markets.
Great, thank you, Cornelia. I don't see any other questions in the chat here, so unless I'm wrong. Are there other things that maybe we wanted to comment on? I think one question that came up in the background briefing yesterday was, we put out the report for consultation, we have made some revisions. Are there some themes that you'd like to highlight in the way in which you address some of the comments? Maybe either one of the co-chairs?
Let's take that. I touched on many of the changes that we've made, and I would say that there's fundamental continuity between the previous report and the final report. But what we've learned through the public consultation process is the importance of being very specific. There were concerns highlighted previously to explain that not all leverage is bad. There is significant heterogeneity, and it's important to incorporate a system-wide perspective. And I think you see that all of those comments have been taken on board in the way in which we have framed this final report. We've also been very careful to explain that this report sits alongside all of the work of the other standard-setting bodies and builds on that work already done by IOSCO, BCBS, and CPAMI, for example. So I would say fundamentally there is consistency, but we have really sought to take on board the feedback so that there's real clarity around the approach that we're taking. And the real approach is one of flexibility, but with the requirements on authorities to make sure that they have measures in place to identify the risks and then appropriately calibrate the measures to take in response.
Great, thank you. Some more questions that came in yesterday, and Sarah, again, you maybe touched on this when you talked about the scoping of these. Are these recommendations targeted at hedge funds? And I think I know what your answer is going to be. But regardless, how is hedge fund leverage changing? How is the use of leverage by hedge funds affecting markets? And is that creating volatility in markets? So maybe Sarah, you could start, and Cornelia, I think we all have views on this, but...
Of course, let me just start by repeating what's been said already, actually, but our focus isn't on hedge funds or their activities, but on the financial stability risks caused by leverage in core financial markets or through interlinkages with systemically important institutions. So it is independent from the type of entity. We're focused very much here on the risks. Obviously, hedge funds are in scope of these recommendations, but so are other types of NBFI if there is financial stability risks caused by leverage in core markets. As I said, we've been really clear that we are not seeking to impose bank-like regulation on the non-banks. We're also very clear that it isn't a one-size-fits-all, and I think that's particularly important when we think about the various different types of NBFI. Andrew's already mentioned the types of financial stability risks that we have seen in previous episodes. I think that is clearly set out. This is important to reflect on what has happened previously. But as I said, no one type of NBFI in scope, but looking at where the financial stability risks can arise through leverage in the core markets.
Yeah, maybe I can also comment. So I think in the past we have looked more, so we say on the regulatory side, on financial leverage. I think where hedge funds are particularly important is in synthetic leverage, so using derivatives. So I think that's maybe a trend that we have seen emerging, and so it's also really important to have these type of entities and this type of activities within our scope.
Sort of an add on this. One of the things, I mean, it's not of course aimed specifically at hedge funds. But on the subject of hedge funds, one of the things that hedge funds often say to me is, well, look, we have demonstrated that we can deleverage our positions successfully. We've done it. Moreover, our investors are under no illusions that if the consequence of doing that is that we take losses, well, we know where the losses sit. And I accept those arguments. The point I think we have to make in the context of financial stability is that there's another part to this argument, which is, yeah, but what are the consequences for the wider system of that? Where are the points of stress where your actions can spill over into other parts of market and call financial stability risk? And that's really at the heart of this. It's not saying, a hedge fund per se is a problem. It's what are the consequences in terms of financial stability, in terms of spillovers, of what we might see in certain stress conditions.
So another question that we received earlier, almost impossible to answer, but I'll throw it out and see how everybody handles it. Which specific area of non-bank financial intermediation has the most concerning use of leverage from a financial stability point of view? So they're asking for specifics here.
Well, look, I mean, I'll start. I mean, one reason to be quite cautious about answering this question is recent experience, around April, because I think many of us would probably have said, based on what we knew, well, it's going to be the basis trade, and actually, it probably wasn't the basis trade. Actually, it was more in the action was more in the swap spread, but it could have been. That's the point. So, I think giving sort of definitive answers in abstract to that sort of question are A, difficult and B, dangerous. And it does indicate that we have to develop tools where we can, once we've got the data, we've put the sort of the recommendations into practice, or as we're doing so, we can also, in the context of surveillance, test these propositions, because it will always be context specific, it will be situation specific. So there isn't an abstract answer to that question, I suspect.
And I would add that it's simply an area that has been growing a lot. So, and this is what is concerning because we may not yet fully understand it. In particular, if you think about the data gaps that Andrew has elaborated on earlier, and the fact that it's also an international business, I think that makes it, a bit opaque. And this is probably the element I would like to stress.
Well, I'll just add to say that I think what we saw through this work and actually what we've seen previously is the common themes of concentration, crowdedness, and where leverage is hidden. So that's where the core recommendations, particularly the first set around data and visibility, are so key to our ability to then address it.
I actually liked the question because I thought it was going to hit back on some of the themes. The idea that precisely because we don't have the data and we can't determine where the next vulnerability is going to be exposed, I thought that was interesting. That's why we can't point to this specific area. If I knew where the leverage was, if I knew where the vulnerability was, I could address it. And I think the other aspect that comes out in the recommendations for sure, is there's a lot of cross-border elements here. So if you have an issue in one area that is funded from abroad, you can get those spillovers abroad, which just makes things so much more complicated and complex. So I think that is another reason why it's really hard to identify this specific area. Let's see what other questions we had. How do we expect, there's a couple of questions on jurisdictions and how they will implement. How do we expect implementation of this to take place? We talked earlier about how we will encourage it, but the approach has several steps: the identification of the vulnerabilities, the core markets. So how are we expecting jurisdictions to take these forward? What's their next step as opposed to the FSB's next step? Does anybody want to take that one?
I can start. I mean, I think we've been very clear that the report has a set of recommendations where, consistent with some of the other international work streams, so very much the BCBS work and the other work at IOSCO that I referred to, but that then it is for jurisdictions to implement against these set of recommendations. The risks and the measures will be different per jurisdiction, but that's where the coherence of this work through the Financial Stability Board is so important, so that there is consistency of outcome and that there is a good understanding globally, particularly of where risks might emerge from a consistent approach to data.
Great. I have a question here that, Andrew, this one is coming in for you. From a UK perspective, does the Bank of England, so you got to take off your FSB chair hat for a few minutes here, does the Bank of England have a preference regarding how it implements these proposals in regard to the gilt market? For example, is there a preference between minimum haircuts in gilt repo versus mandatory clearing of gilt repo?
Well, I can refer back to the event we had earlier on the financial stability report, because what we're planning to do is put out a discussion paper during the second half of this year on this very question as to, what is the appropriate way to address this question? Is it gilt repo? Is it clearing in the gilt repo market, or is it some form of guidance on marshalling? And we're going to do that with the FCA because it straddles both of us, and actually because our Treasury and Debt Management Office will be involved as well. So look, the approach we're going to take in the discussion paper is we're going to lay out the issues. We're going to lay out the various ways in which this could be tackled. We're not going to come down and say, therefore, we're proposing to do the following, because that's the whole point of having a discussion paper. But it will be done in the sort of spirit of, look, this is an issue that has to be tackled. So one way or another, we think this is an issue that has to be tackled. So we're not at this stage at the point, anywhere near the point of prescribing gilt repo clearing, for instance, but we will certainly put it on the table.
Great. There's a couple of questions on central bank liquidity to non-banks. Does the FSB have a position on central banks providing liquidity to non-banks? Are more central banks looking at creating lending facilities for non-banks? Is that a good idea? What non-banks should have access? So thoughts on this?
I can put a Bank of England hat on if you like again, probably for that one. You may want to come from an ECB hat on. Yeah. So look, we've following the LDI incident, we have looked at this very hard because what happened in LDI was that, and we might, by the way, in some circumstances it might have been true in that one. The right answer is that the central bank has to step in and purchase outright, secure assets, in that case, gilts. But we've also used it as the opportunity to say we would prefer always actually to come in and conduct repo transactions because obviously we can unwind those transactions naturally. So we would much prefer a naturally temporary transaction as opposed to a transaction that's temporary because we then sell the things, but we're not quite sure whether we can. And so we actually are in the process of introducing a repo facility for selected non-banks, and I'll come back to the word selected. However, there's a really important point to emphasize here that this is not what we would call a standing facility. We're not providing standing liquidity to any non-bank. In other words, any non-bank can turn up here and say, I fancy a bit of liquidity today, here's some assets. That we regard as a unique feature of the banking system. And that's because banks are providing money in that sense, and it's maintaining the liquidity of money, the so-called singleness of money. Now, I have to say that when we announced this facility, you may think he's been speaking with a certain degree of force at this point because I've had to answer this question many times. Because quite reasonably, people said, "Well, hang on, you've just breached one of the sort of theological principles of central banking. You've gone and offered central bank liquidity to non-banks." And I said, "Look, we're distinguishing here between an emergency facility which we trigger." No non-bank can turn up here and say, "Can I have some liquidity, please? I have a right to it." To say, "No, you don't." We would have to decide that the stress was such that it justified the triggering of this facility. But we think that given this, as I was saying in my remarks earlier, given the scale of the growth and role of the non-banks, this is an appropriate thing to have and a sensible thing to have. Now, we've started reasonably cautiously by saying which non-banks are likely to want it, which non-banks do we feel comfortable and frankly can have legal agreements with. So we're starting reasonably cautiously in the sort of insurance and asset management world, and we'll see how it goes from there. We're not making any promises thereafter, I would say. So I think it's part of the toolkit, but has to be very clearly delineated. Cornelia.
Yes, so I'm not aware of an official ECB position, so let me just give you my own thoughts. So on the one hand, you can say that giving NBFIs access to central bank facilities and liquidity in particular can help stabilize markets, of course, in certain situations, and may also be a backstop and avoid deeper crises. But on the other hand, we have a strict mandate that we should provide credit to solvent institutions. We have a very elaborate, pretty strict counterparty framework for banks. They have to be regulated and fulfill all kinds of conditions. So I would say a precondition for giving NBFIs access to central bank liquidity should be that they should be regulated in a very similar way. And that is currently obviously not the case that we're working on, but I'm fully with you. So in view of the growth of the sector and its importance, it's probably something we should keep revisiting from time to time, both in terms of how are they regulated and how systemically important they are.
Yeah, I think that's really important. I was just going to add, I think, the theology, of course, of this in central banking terms is that if the central bank provides liquidity to the banking system, that liquidity will find its way wherever it needs to go to, as it so that it'll just sort of get into the system and all problems will be solved. And I think the reason this has become an issue is that the growth of the non-bank sector is such, and the activity of the non-bank sector, its scale and nature is such that I don't think we feel confident that that principle holds in the world we're in today in the way that it has done historically. Now that's probably opened the challenge as an argument, but I think that's the underlying point, that the traditional bank dealer mechanism, which is where you put the liquidity in as a central bank, isn't necessarily now capable of, I think, sort of handling all the needs in all the situations.
So I have a question here. I was asked if we could be more specific about some of the changes that were made between the time of the consultation and the report. So I think I can be fairly specific, but I will then turn to the co-chairs to see if there's anything they wanted to emphasize. I think one thing that we attempted to do was to emphasize how the work that we are doing complements the work of some of the other standard setting bodies. I think there's obvious overlap with the Basel Committee's work. I think some work with IOSCO and CPMI, so I think we tried to address that. I think some of the feedback was on trying to be more balanced in our presentation of leverage. We talked about the risks, but we tried to introduce more about the benefits. Financial Stability Board, we think about risks, so we have a tendency to think on the negative side, but we tried to be more balanced there. I think there were questions about how the principle of same risk, same regulation would be applied, so I think we tried to add some more detail about that. And given that this, the greater flexibility and the jurisdictional approach was emphasized, I think there was more added in terms of like principles for the jurisdictional approach. I think those were explicit changes. I think there was one other thing that struck us maybe in the feedback, which was in terms of the data, which we've hit on several times. There was a lot of feedback about the fact that the authorities themselves should be sharing the data more often. Rather than doing new data collections, why don't the authorities share data? So that, I don't think we made a change as a result of that, but it's something that really struck us. So was there any, I don't want to take away from the co-chairs, but I think that was, I'm trying to address the more specific, could you be telling me more specifics?
I don't think you've missed anything there, John.
Okay. A couple more questions have come in. Given the cross-border nature of MBFI leverage, do we want some sort of degree of convergence in the policies adopted by major jurisdictions? Would that be desirable? So I think this is a question about what if people adopt different things? We have a little bit of regulatory arbitrage. Does that create more financial stability issues?
Maybe I can have a first go. So I think for us it's really important that the issues are addressed by the various authorities, as we explained before, with sufficient degree of flexibility, because they're all in different situations. And for us it's really important to have this integrated approach where you have first a domestic framework in place to monitor the financial stability risk created by leverage, and then take steps to address these risks. And here it is really important to have this cross-border cooperation because, of course, leverage is very often within business models that involve cross-border activities. And here international cooperation is crucial to support the risk monitoring, as we talked about before. It's important to have the data and to know what's going on, but also achieve, maybe I should say, not the same response, but to have coordinated responses to stress in case of stress. So first we want to understand what's happening elsewhere, and then we want to be able to respond to it. And I would say it's, possibly we could also have harmonized policy measures, but I don't think it's a necessity.
Does anybody else want to add? So I have two questions that I'm going to combine here. They're on, so the role of the firm's own risk management versus what regulators would impose on them. And then we talk about the public-private partnership. Can we say a little bit more about that? So, public-private partnership?
Well, let me start. I mean, I sometimes think of this as a bit of a three-line of defense type model. So firstly, firms, their own risk management, making sure that there's visibility and that they're managing the risks that might be caused to financial stability through leverage in the non-bank sector. A second line of defence, if you will, could be the counterparties, the leverage providers, and the third, of course, regulators. And I think everybody has a role here, crucially enabled by data, by visibility of data, so that we can determine where those financial stability risks might arise through crowdedness or concentration. It's by all of those participants working together that the financial stability risks can be addressed. I think in terms of the public-private partnership recommendation, which is quite deliberate within the report, and that is an area, John, where we went into a bit more specificity through the consultation process to more explicitly recognise the potential role that a public-private partnership could play, knowing that it is really important in this space to maintain the confidentiality of commercially sensitive information and recognising that industry, there's good track record through the FX Global Code, through the libel transition of where that's worked really well in finding an industry solution to making sure that the the information is disclosed in a way which helps ensure that it's with all of those lines of defence as needed. So a bit more emphasis, and that could be an area of focus going forwards as well.
I don't have any other chat messages here. Does anybody have a final message that they wanted to give, or?
I was going to add to what Sarah's right in what she said. I think that because there's always a key role for us as authorities, and both domestically and globally in terms of the spillovers. That again, firms, we want to improve the line of sight that firms themselves have, because their risk management, Sarah Wright says, comes first when she talked about the three lines of defence model. I think in this context, though, the three lines of defence, as you were right saying, Sarah, also includes the fact that we have to be able to see and look and assess the spillover effects. Because I don't think firms on their own can get there on that.
Great. Any other last messages? Great. I just want to thank everybody who joined us. Really appreciate the interest in our work. Greatly appreciate the time you're taking. So thank you very much, everybody. Thank you.